Here's the brutal truth that will save or destroy your trading account. By the time you see the trend, you're already late. While amateurs chase breakouts and momentum, professionals have been positioning for weeks. They're not predicting the future, they're reading the present with surgical precision. Jesse Livermore understood this invisible moment better than anyone. In 1929, while the crowd celebrated new highs, he spotted subtle hesitations in the tape 3 weeks before Black Tuesday. That observation netted him over 100,100 million in today's money. The amateur sees a stock break 5252 and buys. The professional spotted accumulation at 4747 and positioned accordingly. This isn't about crystal balls or market timing. It's about reading the market's body language before it speaks. Every major trend whispers before it roars, but you need to know what silence sounds like. The invisible moment occurs when smart money quietly accumulates while retail traders dismiss the action as dead money. Your brain craves confirmation. You want headlines, momentum, crowd validation before committing capital. But by then, the easy money belongs to those who position during the boring phase. Consider this scenario. A stock trades sideways between 4848 to 5252 for 6 weeks. Headlines are quiet. Volume appears average. Amateur traders move on to more exciting opportunities. But professionals see something different. Each dip to 4848 finds fewer sellers. Each rally to 5252 meets less resistance. The range is tightening, and more importantly, the character is changing. What does character change look like? Selling pressure diminishes on each test of support. The stock touches 4848 5 times over 6 weeks, but each touch shows fewer sellers willing to part with shares at that level. Meanwhile, rallies toward 5252 encounter progressively less resistance. These aren't dramatic moves, they're whispers that only trained eyes interpret. The amateur reacts to obvious moves. The professional anticipates subtle shifts. This distinction separates consistent winners from perpetual losers. Livermore's maxim: the market will tell you what it's going to do, but you have to listen with your eyes, not your ears. Price is the only headline that matters. Volume is the market's tone of voice. Opinion is noise. Headlines arrive after the move, not before it. Your job isn't to predict, it's to position when the odds shift in your favor. Think about the mechanics actually happening during these quiet periods. Smart money doesn't announce intentions. They don't send press releases when accumulating positions. Instead, they work methodically, buying weakness and absorbing supply without creating obvious price spikes. This explains why volume appears normal. They spread purchases across time and multiple sessions to avoid detection. The invisible moment reveals itself through character changes most traders ignore. Pattern interrupt. The best trades often feel slightly wrong when you make them. This counterintuitive feeling arises because you're positioning before the obvious confirms, before the market validates your thesis to everyone else. It feels uncomfortable because it contradicts herd mentality, the urge to wait for certainty. But certainty comes at a price, usually a much higher entry price. Here's where amateurs consistently fail. They mistake quiet for dead. When a stock trades sideways for weeks without headlines, they assume nothing happens. They chase stocks making big moves, breaking out with obvious momentum. But those obvious moves often mark the end of the story, not the beginning. Real opportunity was positioning during boring accumulation when nobody paid attention. Professional traders embrace this discomfort. Understanding it signals they're operating in the optimal opportunity zone. Livermore's genius lay in reading subtle shifts in market character. He understood markets operate in cycles of accumulation and distribution. During accumulation, smart money quietly builds positions while crowds remain distracted. During distribution, smart money methodically sells holdings to eager buyers chasing momentum. The invisible moment marks transition from accumulation to markup phase. This principle applies across all time frames, whether examining daily charts for swing trades or weekly charts for position trades. The same pattern repeats. The psychological challenge is enormous. Positioning during the invisible moment requires acting when everything feels wrong. The stock appears dead. Volume seems unimpressive. There's no excitement, buzz, or confirmation from other traders. Natural instincts scream to wait for obvious signals. Those obvious signals mark the end of easy profits, not the beginning. Professional traders train themselves to be comfortable with discomfort, to act when setup is right rather than when it feels right. Identity decides behavior. The amateur waits for headlines to grant permission and buys obvious breakouts. The professional defines pivotal points before moves and watches how price behaves approaching them. He notes speed, size, and silence. He wants refusal to drop back into range. He wants real buyers, not just noisy prints. If the level holds and character improves, he takes a starter with modest position size and hard stop. If not, he stands down without regret. One needs excitement. One needs evidence. 2 questions to hold. What exactly defines Livermore's pivotal point? And how do you confirm the invisible moment without chasing obvious breakouts? We'll answer the first now, then close both loops by the final chapter. Understanding this invisible moment transforms your entire approach. Instead of chasing obvious moves, you learn to position during quiet accumulation phases. This shift separates consistent winners from perpetual losers. Most traders buy noise, not pivots. They chase momentum and hope it continues, entering trades where risk is undefined and reward uncertain. Professionals buy places, not prices. They wait for the market to reach specific levels where risk becomes small and information rich. Livermore didn't predict, he prepared. He circled levels in advance and let the tape decide. This patience separated him from speculators who gambled on hunches and lost fortunes chasing every wiggle in price. The amateur pays retail for obvious moves. The professional buys wholesale during compression and uncertainty. A pivotal point is where the market must show its hand. Think of it as a courtroom where price testifies under oath about its true direction. It's a prior high or low, a range boundary, or any level where character can decisively change. At these crucial junctures, you demand 3 confirmations before risking capital. First, range compression must precede the move. When a stock trading in a 4-4 range compresses to 1-1, pressure accumulates like steam in a kettle. Something must give. Second, the initial push-through must be assertive with expanding volume. Volume is the market's tone of voice. Whispers indicate uncertainty. Shouts indicate conviction. Third, price must refuse to immediately fall back below the pivotal level. This refusal proves the breakthrough wasn't accidental. Markets test every significant level. The question isn't whether price pulls back, but whether it holds above the pivot during that inevitable retest. TechCorp illustrates this perfectly. It trades between 2.8, 2.8 to 3, 1.31 for 8 weeks, while amateurs dismiss it as dead money. The range compresses to 29. 5, 0, 29, 50 to 30. 5, 0, 30, 50 as volatility fades. On day 42, an assertive burst lifts price to 31. 20, 31, 20 on, 160%, 160%, average volume. Then it pulls back to 30, 8530, 85, hesitates, and buyers appear quickly. The tape shows higher lows on pullbacks, no heavy selling. A professional takes a starter at 31, 2, 5, 3, 1, 25 with a stop at 30, 6, 5, 3, 0, 65 below both the pullback low and range top. That risks 0.6, 0.6 per share. With a 100,000 account, he risks 0.25%, 0.25%, or 250250. Position size equals 250250 divided by 0, 600, 60. Approximately 417 shares. 1/4 of planned allocation. If wrong, the day ends with a paper cut. If right, he'll pyramid on confirmation and let the market subsidize larger exposure. The amateur bought the first tick at 31, 2, 0, 31, 20, panicked during the pullback, and sold at 30, 8, 5, 3, 0, 80, 5, exactly when the professional was buying. The protocol demands discipline over emotion. Mark the level in advance. Decide above here. Bulls must prove themselves. This advanced preparation prevents emotional decisions during market hours. You're executing a predetermined plan, not reacting to price action. Wait for the first assertive push-through on expanding volume. Don't buy the first tick. Patience saves you from false breakouts that immediately reverse. Many failed trades result from premature entry during the initial probe. Watch the pullback with surgical focus. If it holds above the pivotal point and tape firms, take your starter. Firms means buying interest emerges during the retest, not panic selling. Higher lows during pullbacks indicate continued accumulation. Absence of heavy selling suggests supply absorption. These subtle signs separate real moves from head fakes. Place your stop just below the failed level. No exceptions. If the market can't hold the pivotal point, neither can you. This isn't about giving positions room to breathe. It's respecting what the market tells you. A failed pivot means your thesis was wrong. Accept it immediately rather than hoping it repairs itself. Size for survival, not home runs. Risk 0.25%. 0.25% to find 2 to 3% opportunities. This conservative sizing allows multiple wrong trades without significant account damage while positioning for meaningful gains when right. The amateur risks 2%, hoping for 10%. The professional risks 0.25%, 0.25%, targeting 3%. Over time, the professional's approach compounds wealth while the amateur's destroys it. The mathematics work in your favor with proper sizing. Risk 0.25%, 0.25% per trade. Win 60% of the time with 2 to 1 reward risk, and you generate consistent profits. Winners average 0.5% gains. Losers 0.25% losses. Over 100 trades, 30% on winners, 10% on losers, net 20% gain. Not exciting, but profitable and sustainable. Position sizing psychology reveals trader identity. Amateurs want immediate gratification and size for maximum potential profit. Professionals want consistent profits and size for maximum survival probability. You can't control outcomes, but you control position size and risk management. Fear and greed live in stories. Discipline lives in numbers. On a 100,000 account, risking 0.25% feels small. It's the secret to compounding. Another example. A biotech compresses between 17.801.780 to 18.601.860 for 13 sessions. On day 14, it pokes to 18.751.875. On 140%, volume slips to 18.401.840. Then, firms fast. No heavy offers. The professional buys 18.7818. 78 with stop at 18.3418.34. Risking 0.440.44. He sizes to lose 200.200 maximum. The stock grinds to 19.6019. 60. Pulls to 19.221.9. 22. Then rips to 20.10.2.0. 10. He resists, adding immediately. Confirmation is for adding size, not starting positions. Price is the only headline that matters. Volume is the market's tone of voice. The best trades risk nickels to find dollars. These maxims guide decisions when emotions run high. Headlines lie, opinions mislead, but price action reveals truth. Great entries often feel uncomfortable because they're early and quiet. This discomfort indicates your position before the obvious becomes obvious to everyone else. Comfort is a trap. If you feel terrific buying, you probably bought late and joined a crowd. The real edge isn't the initial entry, it's what you do next. Confirmation is for adding size, not starting positions. Your starter is reconnaissance. The real money comes from building size when the market validates your thesis. So how do you confirm without chasing? You learn that waiting itself is a position. Amateurs need immediate gratification. They pile into breakouts expecting instant profits, then panic when normal pullbacks occur. Their emotions drive decisions, not market behavior. They buy hope and sell fear, consistently transferring wealth to those who understand market psychology. Professionals operate differently. They understand that confirmation is behavioral, not emotional. They let the market prove them right before pressing their advantage, transforming trading from gambling into systematic profit extraction. The amateur wants action and excitement. The professional wants information and evidence. This fundamental difference separates consistent winners from perpetual losers who chase every market wiggle. After taking your pivotal point starter, the hardest part begins: waiting. The market rarely moves in straight lines. It tests your resolve with sideways action, minor pullbacks, and periods of apparent weakness. This is where amateurs get shaken out and professionals get positioned for larger moves. Your brain craves immediate validation. When price doesn't surge after entry, doubt creeps in. Maybe you were wrong. Maybe you should cut losses quickly. These thoughts destroy more accounts than bad entries. The market's job isn't to make you comfortable, it's to separate weak hands from strong hands before delivering profits to those who earned them through patience. Following the Tech Corp entry at 31, 2, 5, 3, 1, 25, price spends 3 hours chopping between 31, 1, 0, 3, 1, 10, and 31, 6, 0, 3, 1, 60. Social media calls it failed breakout. Amateur traders pile on with negative commentary. An amateur adds aggressively at 31, 5, 5, 3, 1, 55 from fear of missing out, then panics out at 31, 1, 5, 3, 1, 15. When it retests support, he bought high from emotion and sold low from fear. The professional does nothing during this chop. Why? Waiting is a position that pays dividends. He wants the market to subsidize his risk before adding size. Every hour, price holds above 31, 1, 0, 3, 1, 10. His thesis strengthens. Every failed attempt to break back below the pivotal point reduces his risk. The market works for him, not against him. The confirmation protocol demands multiple factors align before adding size. Time factor requires 2 to 3 closes above the pivotal point. Spikes don't count. Sustainability does. 1 strong close above pivot might be noise. 2 closes suggest building strength. 3 closes indicate established support at the new level. Character factor examines how pullbacks behave. Do they get bought faster than previous pullbacks? Do lows print progressively higher? Does selling volume diminish on each dip? These subtle signs indicate smart money continues accumulating while weak hands shake out. When Tech Corp slides from 31, 6031, 60 to 31, 22, 31, 22, on half its earlier up volume, then immediately prints bids at 31, 2, 8, 3, 1, 28, 31, 3, 1, 3, 1, 31, 31. 35, 31, 35. Buyers are asserting control. Volume factor shows expansion on moves higher, contraction on pullbacks. This pattern suggests institutional accumulation rather than retail speculation. If advances print 140, to 180%, 180% of average volume, while dips show 6060, 80%, 80%, you have sponsorship. That asymmetry tells a story. Someone pays higher prices with intent while sellers run out of ammunition. The ad trigger combines these elements. First, constructive pullback that holds above pivot, followed by higher high on expanding volume. Constructive means the pullback finds buying interest quickly without heavy selling. When Tech Corp subsequently pushes to 31, 80, 31, 80 on 170%, 170% volume after holding 31, 1531, 15. You have confirmation. When confirmation arrives, add 2525, 33%, 33% more to your position. With TechCorp, if your starter was 400400 shares, add 100100 to 130 shares on confirmation. Immediately raise your stop to reduce dollar risk on the entire position. Your original stop was 30, 6, 5, 3, 0, 65. After adding on confirmation at 31, 70, 31, 70, raise the stop to 31, 0, 0, 3, 1, 0 for all shares. This reduces total dollar risk while increasing position size. The market subsidizes your risk as it validates your thesis. Never let total risk expand beyond your original plan. If you plan to risk 250 maximum, stick to that number regardless of how many shares you own. Position sizing discipline separates professionals from gamblers. Professionals add to winners when risk decreases. Amateurs add to losers when hope increases. After TechCorp holds 31, 25, 31, 25 for 2 days, and pushes to 31, 70, 31, 70. You're showing small profit. Natural instinct says take profits before they disappear. Professional discipline says add size because risk decreased. Your stop moved from 30, 6, 5, 3, 0, 65 to 31, 31. Reducing per share risk from 0, 6, 0, 0, 60 to 0, 2, 5, 0, 25. The market paid you to increase exposure. Amateurs do the opposite. They cut winners early from fear and hold losers hoping for recovery. Waiting is a position that pays dividends. Add when the market pays you, cut when it charges you. Patience is the professional's secret weapon. These maxims guide behavior when emotions run high. During confirmation, you'll feel pressure to act. Price chops around, creating noise that demands response. Your job is watching behavior, not listening to opinions. Does price hold the pivotal point? Do pullbacks find buyers? Does volume expand on advances? These questions matter. Everything else is distraction. Pattern, interrupt. Doing nothing often produces better results than doing something. Activity destroys more accounts than inactivity. This counterintuitive truth challenges action-oriented personalities. The best traders spend most time doing nothing, waiting for optimal opportunities. When those opportunities appear, they act decisively. Most of the time, they wait. How much should you add? And when do you stop pyramiding? That's the art of building size without building risk. Next, we construct the pyramid, adding to strength without falling down the stairs. Amateurs pyramid backward, they double down on weakness and take profits in strength. This natural instinct destroys accounts systematically. When positions move against them, they add more shares, hoping to average down and recover faster. When positions move in their favor, they take quick profits, fearing gains will disappear. Professionals pyramid forward, they add size as the market subsidizes their risk and proves their thesis correct. They understand that adding to strength while raising stops transforms good trades into great trades. The distinction isn't about courage or conviction, it's about mathematics and market behavior. With TechCorp holding above 3131 and showing confirmation, the professional doesn't celebrate, he prepares to build. Celebration belongs to amateurs who think one good entry guarantees profits. Professionals know the real work begins after initial positioning. But pyramiding isn't about getting bigger. It's about getting better positioned as risk per share decreases. Each addition should improve your overall risk-reward profile, not just increase potential profits. The goal is building size while the market subsidizes your risk, transforming unrealized edge into controlled leverage. TechCorp pulls back to 31. 3531, 35, holds with minimal selling pressure, then breaks to 32, 2, 0, 3, 2, 20, on, 100, and 80%, 180% volume. The professional adds his second quarter at 32. 2, 5, 3, 2, 25. His aggregate stop now trails at 31. 1, 5, 3, 1, 15 above break-even on his starter, and below the constructive pullback. Dollar risk hasn't increased. It's actually decreased per share. His original starter of 400,400 shares at 31, 2, 531, 25 with stop at 30, 6530, 65 risked 240, 240, after adding 300300 shares at 32, 25, 32, 25, and raising the stop to 31, 1531, 15, for all 700700 shares. His total risk becomes 700700 shares times 0, 350, 35 average risk equals 245245. Position size increased while total dollar risk remained constant. When price reaches 33, 1033, 10 after another pullback and breakout, he adds his final quarter at 33, 1533, 15. Total position, 900900 shares across 3 tranches. Aggregate stop, 32, 00, 32, 0. His risk calculation, 900, 900 shares times average 0, 250, 25 per share equals 225225 total risk. Each addition improved his risk-reward profile while building meaningful exposure. The amateur bought full size at 32, 203, 2, 20, froze during the pullback to 31, 70, 31, 70, then sold at 32, 8032, 80 from fear, missing the entire subsequent move. He added stress. The professional added structure. The protocol for professional pyramiding demands strict discipline. Limit total additions to 2 or 3 increments maximum. More pieces create unnecessary complexity without improving results. Every additional layer requires monitoring and decision-making that can cloud judgment during critical moments. Add only on strength emerging from constructive pullbacks, never in the middle of choppy action. Constructive means the pullback finds buying interest quickly without heavy selling pressure. You want evidence that demand exceeds supply at progressively higher levels, not random price movement. After each addition, raise the aggregate stop under the newest higher-low structure. This is non-negotiable. If you add at 32, 25, 32, 25, after a pullback to 31, 35, 31, 35, your new stop should protect both positions above the pullback low. This ensures the market pays for your increased exposure through improved structure. Each subsequent add should be smaller unless volatility contracts and stops can tighten further. Your starter might be 400400 shares, first add 300300 shares, final add 200200 shares. This pyramid structure reflects decreasing opportunity as moves mature while maintaining disciplined risk management. Total position risk should never exceed 1%, 1% of account, regardless of how many pieces you add. On a 100,000 account, maximum risk per idea caps at 750,750. Your starter risks 250,250. First add risks 250,250 after raising stops. Second add risks 250,250 after raising stops again. As stops rise, dollar risk per share decreases, while position size increases. This mathematical framework ensures consistent risk management across all positions, while allowing meaningful profit participation in validated trends. Consider the complete mathematical progression. Starter at 31, 2531, 25 with 400,400 shares. Stop at 30, 6530, 65, risks 2, 40240, Add 300300 shares at 32. 2532. 25. Raise stop to 31. 1531. 15 for all 7. 00. 700 shares. Blended entry price 31. 68. 31. 68. Risk per share 0. 53. 0. 53. Total risk 371. 371. Wait. This exceeds our target. The professional adjusts by adding only 245200 shares, keeping total risk at 245245. Final add of 150150 shares at 33. 1533. 15. Stop raise to 32. 0032. 0 for all 750750 shares. Total risk 225225. Each addition improved the risk-reward profile while building meaningful exposure to the trend. Build size only when the market subsidizes your risk. The trend should pay for your additions, not your account. Bigger isn't better, better positioned is better. These maxims guide pyramiding decisions when emotions run high. Natural instinct says take profits when you have them. Professional discipline says add size when risk decreases. The market tells you when it's safe to increase exposure through price action and volume patterns that confirm continued sponsorship. Pattern interrupt. The most profitable positions often feel the most comfortable because they're built correctly. This comfort comes from proper risk management, not wishful thinking. When stops protect your capital and the market validates your thesis through higher highs and higher lows, you can relax and let the trend work. Contrast this with poorly managed positions that create constant anxiety about potential losses. Professional pyramiding requires recognizing when opportunity diminishes. Early additions work because you're still in the acceleration phase. Later additions face increased risk because moves become extended and vulnerable to reversal. When your additions stop working immediately, the trend is aging. The tape will signal the party's end before the crowd realizes it's over. So when does the invisible beginning become the invisible end? Exit rules complete the cycle. Amateurs treat exits as failure. They cling to positions from hope, viewing any sale as admission of defeat or missing bigger gains. Fear of giving back profits freezes them at exactly the wrong moment, while greed for just one more push keeps them exposed when smart money exits. Professionals treat exits as harvest time, the culmination of disciplined positioning and patient execution. They understand that knowing when to sell separates good traders from great traders. The same tape that whispered the trend's beginning whispers its end, but it rarely sends a formal announcement. Your job isn't predicting the top. It's recognizing when character changes from accumulation to distribution. Livermore said the big money is in the sitting. But he also knew when to stand up and leave the table. The invisible moment works in reverse. Just as trends begin quietly through accumulation, they end quietly through distribution. Smart money doesn't dump shares in dramatic fashion. They distribute methodically, while retail traders still believe in the story. Headlines remain bullish, analysts upgrade targets, and momentum chasers pile in exactly when professionals begin lightening positions. This process unfolds over weeks, creating extended topping formations that frustrate both bulls and bears. The market shifts from eager bids chasing highs to hesitant upticks that close weak. Volatility expands at wrong places. You see highs that don't hold, tails that lengthen, and opens that fade. Professionals sense supply returning before headlines notice, recognizing that waiting is still a position, but now the position is cash. End of trend signals mirror beginning of trend signals in reverse. First, failure to follow through appears as new highs that close weak repeatedly. Price reaches 35. 8, 0, 3, 5, 80, 36, 1, 0, 3, 6, 10, 36, 2, 5, 3, 6, 25, on successive days, but closes at 35, 2, 35, 5, 0, 3, 5, 50, 35, 4, 0, 3, 5, 40. Range expands upward, while volume dries up on advances, then swells on reversals. This suggests supply enters at higher levels, while genuine buying conviction disappears. Second, character deterioration shows pullbacks, deepening and lasting longer. Instead of quick dips finding immediate buying, corrections extend over multiple sessions with diminished institutional support. Lower highs appear on intraday action, even while daily highs continue advancing. Third, addition failure occurs when your last pyramid ad gets chopped immediately. Breakout attempts meet swift rejection, indicating sponsorship has ended. Your own protocol, designed to add to strength, now tells you strength is absent. TechCorp reaches 35, 8035, 80 after your successful pyramiding campaign, then prints 2 attempts at new highs that fail intraday, closing near 34, 9, 0, 34, 90. These are immediate red flags demanding attention, not explanation. Next session shows 35, 2035, 20 to 34, 10, 34, 10 range, on heavier volume than recent advances, indicating increased volatility, where sellers gain ground. Your trailing stop sits at 33, 853, 3, 85, protecting substantial gains. You don't predict what happens next, you observe the unfolding action. Third day brings another failed rally attempt with tape speed slowing on upticks and quickening on downticks. Multiple warning signals cluster. Failed follow-through, expanded ranges with weak closes, and increased selling pressure. The professional sells 1/3 at 35.1, 35.1 into strength, banking profits while liquidity exists. He tightens trailing stop to 34, 0, 0, 34, 0 for remainder, converting paper profits into protected equity. When price breaks 34, 0, 0, 34, 0, he exits completely at 33, 85, 33, 85. Total profit, approximately 2, 502, 50 per share on 7, 50750 shares equals 1,875, 1,875, gain against 2, 25, 225, maximum risk in 8, 3 to 1, 8.3, 1 reward to risk ratio. The amateur moves his stop to give it room and donates 3 points back to the market. His reasoning, it's just normal pullback. I don't want to get shaken out. This emotional decision costs him 2,252, 250 inches. Profits as TechCorp slides to 31, 20, 31, 20 over subsequent sessions. He held through the entire reversal, transforming a winning trade into a scratch or small loss. The professional banked gains and moved on to the next opportunity. Exit protocol combines mechanical and behavioral components with mathematical precision. The mechanical component involves trailing stops under the last valid higher low or moving average you actually respect. Don't use random percentages or round numbers, use structural levels that mean something. If 33, 8, 5, 3, 3, 85 represents the last higher low in an uptrend, that's your mechanical stop. No narrative exceptions, no just-in-case grace periods. When structure breaks with authority, you exit without negotiation. The behavioral overlay adds discretion when 3 warning signals cluster. Take partial profits into strength and tighten remaining stops. This captures profits during distribution while maintaining exposure if trends continue. Iron rule: never widen a stop to save a trade. Cut on weakness of structure, not weakness of nerve. Your stop represents the level where your thesis becomes invalid. Moving it lower because you don't want to lose money violates the entire risk management framework. If the market can't hold the level that defines the trend, neither can you. Re-entry mindset acknowledges that trends sometimes repair after brief interruptions. If TechCorp reclaims 34, 50, 34, 50 with authority and rebuilds proper structure, you can re-enter. Pride costs more than commissions. The goal is making money, not being right about every decision. Position sizing discipline extends through exits. As pyramiding built size when risk decreased, harvesting reduces size as risk increases. Your final position of 750,750 shares across 3 tranches gets reduced systematically. Sell 250,250 shares into first warning signals. Tighten stops on remaining 500,500 shares, then exit completely when structure fails. This ensures you capture the majority of trend profits while avoiding the donation phase that destroys amateur accounts. Closing the invisible loop reveals market symmetry. The invisible beginning was the pivotal point, holding with confirmation, smart money accumulating. While crowds remain distracted, the invisible ending is the pivotal structure, failing with distribution. Smart money selling while crowds chase momentum. You now recognize both phases of the cycle, transforming trading from gambling into systematic profit extraction. The market owes you nothing beyond the last high or low. Exit on character change, not account balance. Selling into strength isn't calling tops, it's banking the trend's gift. Actionable recap synthesizes the complete framework. Enter at pivotal points with defined risk, taking starter positions when structure holds. Wait for confirmation based on market behavior to add initial size. Pyramid into strength with rising stops, allowing the market to subsidize increased exposure. Exit when character changes, recognizing subtle signs of distribution and trend exhaustion. Own your process, not your positions. This systematic approach, refined by traders like Livermore, empowers you to navigate the market's hidden currents and capture major trends from accumulation through distribution. If this framework opened your eyes to invisible moments, the next lesson on reading the tape, speed, size, and silence will sharpen your execution even further, giving you the tools to interpret the market's whispers in real time.